Good morning, everyone, and welcome to Fast Market. It is Tuesday, November 20th. I'm Kevin Hincks, joined in studio by Steve Quirk, Executive Vice President at Trading and Education at TD Ameritrade, and our often guest, Scott Bauer, CEO of Prosper Trading Academy. Boys, we're all suited and booted, ready to go, and this market is ripping, but don't call it a comeback. We've about halved our losses here for the day, and this market seems strong, and it seems like it's getting a little lift from Citron upgraded NVIDIA mid-morning, and it went from down to now up on the day, and it seems to have given all the growth stocks a little bit of a bid, a lot of bottom fishing now, and you mentioned it right before we came on the air. This morning's trade, where there was no good news. It didn't matter good earnings, bad earnings, what, there was no good news. Felt like that blow-off bottom that we always talk about. Steve, tell our listeners what you think about, what do traders feel when you hear that almost capitulation blow-off bottom?
I actually have never bought into the fact that you have to have that before you get a rally. But I just think, we've all got a lot of experience, good and bad. And we were all just talking before we started here. You could just felt like it. When the S&Ps were down 60, I was thinking to myself, boy, this just kind of feels like that point where there's some people that are just saying, I'm done buying for a while. And so you've gotten to a point where, and who knows if this is going to hold. I have no idea.
I mean, without notice.
But I would have told you with 80% certainty that we were going to get a rally off of that 60% down.
Scott Bauer, what do you think? What's the mindset that you teach your people at Prosper Trading Academy to stick with on a day like this where, let's face it, it looked really bad, and that doesn't mean we're out of the woods, but it certainly looks a lot better than it did at 8:45.
Absolutely. It's a matter of not being pig-headed. So, if you have an opinion and you're wrong, that, acknowledge it, that's fine. But when you kind of sniff that blood in the water, like you were just talking about, and like I was actually discussing with my clients this morning, that's where you really want to kind of take advantage. And Kevin, we've been talking about this for the last couple hours. Why is VIX only, and I say only, why is it only trading 22, 23,
totally with you,
and not 27, 28, almost 30? So to me, Steve, much to your point here, it really felt like a blow-off bottom.
And I'm glad you brought that up, because I wasn't just looking at the market and saying this is down this much. You look at, and you probably teach your students, we try and teach our clients, look at all the things that that move when we see moves like this. You know what I mean?
Now, but what your view of a 22 VIX, and when you think it should be higher, does that mean it's orderly and not panic, or does that mean maybe we're at the end of this and people are unloading volatility down here?
I think.
Which is it?
I think of it too. There's another element that I bring into it. If I'm going way back, we've all been around a long time, a historical norm is 20 for the VIX. Now, I'll acknowledge it's now teens.
So since to give some color there, since it moved from the OEX 100 to the S&P 500, the average has come down like 15.39
exactly.
is the average.
So I would also say there are more people that are using volatility products as a way to generate income. So they look for opportunities. If you look at when there's a blip up in the VIX, it doesn't last very long anymore. It used to last for quite a long period of time. Now it's met with some pretty intense selling. So to your point, Kevin, that could be what's driving this down. But to me, looking at that move and then looking at what happened with the VIX, I was thinking of it more in the context of, if we're going to keep going down, that VIX would be closer to 30.
Which means sometimes the VIX can go down because there's sellers. Sometimes the VIX can go down because there's no buyers. When I mean VIX, I mean implied volatility, There's just people saying, I'm not going to buy it here. This is where I would get out of it if I was long it, not buy it.
And let me just tell you something to both of these points here. This morning, meaning Prosper and our students, we actually tried selling a VIX call spread for next week. Couldn't get filled. Couldn't get filled, and within 5 minutes, all of a sudden the volatility of the VIX started coming in also, and then at that point it was like, all right, missed it, over. You know what? So maybe we'll get an opportunity later on in the day, but to me, this morning was a real good opportunity.
And I have one question for you, because I find that very fascinating. So I would imagine you teach your students not to chase.
Oh,
Like you pick,
market has to come to us.
Thank you.
Has to come, and if you miss it, okay, you miss it, and you move on to the
Not
next
getting
one.
filled on an order is not the worst thing in the world.
Absolutely not.
Yeah, I always say, like, I like to tell clients, it's your ball. Like, you can take it and go home anytime you want. You know, you can go back to the market and put in an order whenever you want, but don't chase it.
And especially, you know, we all come from the floor trading days when we were market makers, where the markets came to us, right? The offers were hitting our bids. The bids were our bids, you know, were there, and we were getting hit, and people were buying our offers. It's not like that anymore. We are now market takers, not market makers. Doesn't mean that we have to buy offers, sell bids, but you gotta let the market come to you.
Yep.
Guys, another thing that may have been an indicator that this is not the significant downturn that we've seen in the past are the risk-off products, right? Now, we mentioned the VIX, right? But how about this? Gold is down,
I can't figure gold out.
right? Gold is down. How about this? Bonds? Unchanged.
Yeah.
Barely, I mean, they're up a couple ticks. They're in the green, but they're basically not very close from unchanged. No real risk-off assets are acting like they would if this was a serious sell-off or if it wasn't the end of a sell-off. I mean, you decide what you think it is, but anyway, the numbers don't match up to the overall activity.
Right. It doesn't pass the sniff test at this point. Now, there could be a couple reasons for that. One, it's a holiday week, and volumes are a little bit on the light side. Number two, though, you know, in all fairness, gold has really been tracking what the dollar has done.
Exactly.
And, you know, the
You're
dollar
right.
got a little bit of a bid, and,
Yep.
you know, so we see that. But you're right, Kevin. The typical risk-off assets are not getting bid up.
Even our proxy for gold, Bitcoin, isn't getting a bid.
Uh-oh, he now does air quotes with Bitcoin.
Oliver loves it when I mention that, you know.
Oliver's antennas just went up.
Yeah, he's wherever he is, he's like, oh boy,
Finding value in
Yes.
Bitcoin.
Yes.
So, guys, product that hasn't recovered so far today, and that's crude oil.
It's amazing.
Another just annihilation of crude oil, now down 4%. Now what is this? Because, you know, I was talking earlier in the week about the natural gas crude oil trade, and that seemed pretty obvious, and I said the day that it was happening, we're going to hear a story about this.
Yep.
There's a liquidation going on here.
Which there was.
And it turns out that there was. But now you've got crude oil on a day. Remember what Tuesday brings, guys. Tuesday brings inventories.
Yep.
Both the API tonight, the EIA tomorrow, and they've had builds all along. Now, is this preemptive selling because they think we're going to get another big inventory number tomorrow? Because this is 4% ahead of an inventory number. That's a big number, Scott Bauer.
Yes, this is definitely selling ahead because right now it is a sell-first market. It's a sell-first marketplace. Something other that I saw this morning also is over the last 7 weeks, I believe it is, there's been more selling by hedge funds of oil.
Commitment of Traders says that.
Yep. Than in the last, I believe, 6 years or so. 500, I want to say it was 500 million barrels, if I'm not mistaken, on the sell side. That's obviously put a lot of pressure in here, but that to me also could be one of those signs that maybe it's that sign of capitulation. Everybody giving in, but nonetheless we see this.
But I think your point is spot on. Look at everything. The whole board is red.
Right.
It doesn't matter what asset class you're in. If you're in a sell-first mentality, I don't care what earnings are. I don't care what the numbers are. I don't care.
Right.
It doesn't just apply to your equities. It applies to a variety of
Sometimes
asset
they
classes.
just sell everything.
I'm telling you, when you're sitting at the gas pump and you're going like this, and the sign up there is moving faster than the pump, you know something's going on.
Yeah. Sometimes they just sell everything, though. I mean, there's a day where, you know, even the risk-off assets aren't really coming. All right, let's keep moving. We had some economic data today. Teardrops and tidal waves in terms of the economic data. People weren't looking. We had housing starts. Wasn't really a bad number. We had an upgrade. We had a little stronger number than last month, a little lower than expectations, but housing hasn't showed up at all. Why should we start paying attention to it now, right? This is just a continuation of the theme going forward.
Yeah, it was, you know, pretty much a blow-off number, meaning no one really cared that much. But if you really delve into it, yes, the outlook is still really bearish.
Right.
It's not good. But maybe this is showing some sort of bottoming because, like you just said, Kevin, the numbers weren't all that bad given the fact of what we've seen over the last 6-9 months.
All right, and
everything
now,
is met poorly. I
Yep.
mean, it's just everything you can't satisfy.
No.
You can't satisfy.
All right, how about this? We should start a new segment. There's a new segment coming in our future called Head Scratching Trade of the Day, right? Because look at what happened to the retail sector. As we get a Red Book number, 6.2% Red Book number. That is not even in the ballpark of a normal strong number. A 6 handle on Red Book is crazy.
Yeah.
And what is that? Department stores, chain stores, retailers. As we get, the same day we get L Brands, Urban Outfitters, Target, Best Buy, Lowe's, Kohl's, TJX, Ross Stores, all soft, except, of course, Urban Outfitters was the only one that was strong. Everyone else down. On the same day, you get a Red Book number of 6.2%. Like I said, somebody make sense of that for me.
It's crazy. And what that tells me is, the sell-first mentality and the street, meaning retail, maybe, just maybe, they're looking ahead here and saying, you know what? Consumer discretionary income is coming down. People are starting to worry. Maybe things aren't going to be as rosy as these retailers are thinking they're going to be.
Yeah,
Now-
but Dave, I mean, the estimates were 5, right? I mean, we're spending on a year-over-year
They
basis.
don't really give estimates on Red Book, but they give you prior.
I'm saying overall spending, consumer spending for the holidays this quarter, they were saying 5% increase, which is robust.
Huge. Oh, I mean,
huge.
Five handle. You would take a good solid 3 handle on consumer spending. And think about this. Target got punished. Why? Because they're spending money on inventories to pump up inventories. Lowe's got punished. Why? Because they're closing stores and lowering their estimates. Why? Because they're spending money to streamline their business all to the U.S. And the stocks get punished for that because they didn't meet that exact expectations of guidance going forward. I mean, nothing can make these analysts or the people trading these stocks happy. And they have punished both Target. Remember, Target is a company that the CEOs basically come out and said, we want to own Christmas. They've enlarged their toy section because with Toys R Us gone, Target wants to capture that.
Somebody's got to fill that gap.
Right. They've basically turned their business around, invested in their business, and kept sales going well. And boy, no reward.
But
in the stock.
I mean, and Scott, you probably talked to your students about this. There are days when I can tell you the earnings and you would look at the numbers and say, oh my God, I'm going to be playing this stock so long. And then all of a sudden they look at the screen and they said, all right, explain this. I'm sorry, I can't. I cannot explain it.
Sometimes they just don't like anything.
No, today's one of those for sure. We actually had, full disclosure, we had a long position in Kohl's. Reports were really good. They actually raised the lower end of their guidance moving forward.
Right.
Pummeled with the rest of them.
Remember, Marvin Ellison took hold of Lowe's July 2nd. So he's getting his team ready. He's turning things around. He's closing underperforming stores. He's streamlining Canada and exiting Mexico. He's closing their hardware stores. He's getting this thing ready for the future, and he gets no love from that. All right, let's move on to the trade that we did do in Lowe's, which was, the good news is we had a play on in Lowe's that was an earnings play, but it was a put vertical below the market. And we did if you can see here, we did the 84.80 put vertical. And we sold it, and you can see, even though we're wrong in the direction of the stock, we're safe enough away where this is making money on the day, and we only have a couple more days to go. It's dead wrong and profitable. That's going to be on my gravestone.
I absolutely, that's what I love about
playing probabilities.
Exactly.
It doesn't guarantee you're going to do well, but look we missed, right? The stock is down, but our trade's still profitable.
That's why that trade selection is so important.
So trade management, Kevin, what are you going to do?
Well, the question is, stock's trading $88. We're short the 84.80 put vertical. Now we have profits. We don't need to do anything with it. We can just let it go out. But in this environment, I think it's important that we take a look at something like this and just close it. Right? We sold it for higher than this, 28 cents.
I know, right? That hurts a little bit, but
you have one other option.
Close half?
Yeah.
Right.
Which, I mean, that's something that we like to make sure people understand. Every decision is not a binary decision. you have the option.
Yeah, we actually did a 5-lot.
Right.
Yeah.
Look at the option. I see what you did there.
You have the option to actually take off part of that, and then if it moves your way, then
product placement.
Yeah,
that we're doing
product
right
placement.
Here.
Yeah.
Exactly.
Subliminal.
All right, so here's what we're gonna do. You're right. We're gonna close 3 today because we don't know what's gonna happen the rest of the week, and we're gonna close 3, but we're gonna put in about a 20. We're gonna put in a couple pennies below the market.
Ooh,
and let the market come
greedy,
to us.
aren't
Yeah,
you?
look at me. I believe in ebb and flow of these markets.
Yeah, let them
So
come to you.
there we go. So Lowe's is closed. Now, let's move on to our first trade of the day. And yeah, we should really get David Roman in here to talk about this because it's Foot Locker. Because I can safely say that I personally am not their target market from Foot Locker. Their clothes, their shoes is a little bit younger than where I sit. And yeah, none of us. No, zero.
Do you remember when I was on the trading floor? Do you remember what coat I wore? I wore a Foot Locker coat.
A striped jacket,
Yeah.
that's right.
People thought I worked at Foot Locker. I'm like, no, actually I don't.
Yeah, officially I don't. Not yet, anyway. They've got my resume.
Right.
So, Foot Locker. The question is, how do we manage a retail sector that's been just beat up?
Devastated.
Remember, this stock got really beat up when Sports Authority went in bankruptcy, but then it recovered nicely. They weathered the storm, and they've come out on the other side. But they've got their target audience, which is the younger gym shoe or sneaker buying demographic, and it's all Jordan, it's Adidas, and they're big into Nike now, but they're the clothes, right? They're clothes and shoes. So how would we look at something like Foot Locker? Now, here's the problem, and this is a big problem, and this may mean this is a no trade. Do I really want to trade something 31 days out in Foot Locker?
Had this exact same discussion with my students yesterday about a few other ones like TJX.
Yep.
There was one other one we were
Nordstrom, by the way, JW Nordstrom just started weeklies. They didn't have weeklies forever. Foot Locker does not have weeklies. I think that's the difference between trading and not trading, Frank.
I do as well. And to me, I may have an opinion here. I'm going to wait till after the numbers. And if my opinion is reinforced, then maybe I start to take a position. But going in without the weeklies now, it's tough. But what did we do back in the day when we didn't have weeklies, right?
Yeah, exactly.
Or dailies. We just did what we did.
Yeah,
but
you trade it and you just do it a little differently, right?
The one thing that's a little appealing, and you got your cursor on it, is where it is from a volatility standpoint.
Yes.
It's rich.
Exactly right.
It
IV
makes it
percentile,
pretty-
81%.
Yeah.
And we use the option stats page with every trade we do. We always check. That's like the first stop making a decision on what to trade, is using that option stats page.
Right.
So we have that. We know what the chart is. This stock is already corrected down to some pretty, Ben Watson and the guys in Draper would have a field day.
Good levels here,
with technically where that stock sits. So maybe you know what, I insist that we try something here and look at it. Now, you've got a expected move during the period of $7.50, but you've got a $5.60 move in one day.
On earnings.
Right, on the earnings report.
And that's something, Kevin, that is something really important, I think, to explain to everybody.
The difference between
the market maker move, which is the one-day move, which is the earnings event, and then the move to the next expiration, which in this case is $7.50.
One difference between trading a monthly like this and trading the weekly will be the Vega amount.
Sure.
Right? There'll be a bigger Vega number because that Vega is that only Greek that decreases as you get closer to expiration. The other three get more heightened and more sensitive. Vega decreases. So we will benefit from a little higher Vega, probably a little bigger premiums in this as well. But look where we have to go. $7.50 move. We've got to go down to the 40 strike now. Let's look on the chart. What does the 40 stock bring? Look at that. Right there, that 40 line. That's a pretty significant line it was at with a lot of activity down in the past in the last year.
Right.
So if we go out to the 40, remember that 40 line is now, that's about an 81%. Now that's over 31 days. That's an 81% chance of being out of the money. So how about we just do something simple like the 40.37.5. Is that enough?
Pretty wide spreads too.
Well, yeah, only $2.5 strikes.
Yep. It's not enough credit for me.
No, you're right, exactly. See, that's what takes us out of this spread. Because to cover the expected move, both in the day and the month, remember, because you have to play this look at with your eyes on both of those numbers, right? If we go down to the 40 strike, which is, $8 lower, $8.50 lower, they're not paying us. Wonder if we go up 1 and take a look. Now we can do a 42.40. Does that pay us? We don't.
I think we have to look at 42.5.
Hold on. Let's see what we got. Yeah, 42.5, 40. Let's do that one. 57 on $2.50. Closer,
but here's an idea.
Yeah.
If we're looking at that really good support area down there, maybe on the upside we can find a range, I think around 55 or so, where there's some resistance. Maybe we can sell both the put spread and the call spread, which is an iron condor.
Good idea.
Collect somewhat close to 1-to-1 odds. If we can get close to a $1.20 or so on $2.50.
If we do the 42, no, if we do the 42, I did the.
You did a $5 wide.
$5. I knew there was some reason that would have
been
felt
nice.
a little better. No, see, we don't have the 57.
No,
see,
we don't. There's the issue.
Yeah, right. That is something. I knew there was a reason why I went to the $5 because we just bought 3 of our verticals in.
Nicely done.
There you go.
Nice.
So 55.60. That's all we can do there. So $1.40, but it's got upside risk. Let's see what the 55 brings us here. The 55, that'd be, look at that, 55.60. That's back up to the all-time high.
I mean, we're protected up to about 56.5 there.
Right.
Yep.
On that to the upside. It's probably not the worst thing.
All right, here's what we can do. We can do 1. How's that?
Yeah.
Let's just do 1, just so we can learn from what happens and take a look at this and manage it along the way. How's that? All right?
Yep.
All right, we'll do 1. All right, now, we've got everything else. Let's see what else. I got one more topic for you guys to talk about to our viewers, and that is how do people trade? Think about this. The leaders in this market, Boeing, Apple, and Facebook, have all bad headline risk, right? How do people look at these? We got to do it quickly. How should people look at those trades when these companies can't stay off the radar, can't stay off the headline news every day? Does that make it more difficult, or is that when you should be hypersensitive to trading these names? You go first.
Hypersensitive in terms of adding positions or taking something off?
Both, whatever. I mean, should you be watching these when they're in the news like this?
Yeah, I guess I would say if in other words, if I'm looking at a trade that's going to have some duration to it, I'd be less concerned about a headline.
Right.
If I'm looking to trade them on a weekly basis, daily basis, or things like that, I'm very much paying attention to the headline.
Scott Bauer?
We went through this with Tesla for
we
the
did.
longest time, and we played that news cycle. We played the up at 360, and we played the down at 280. Now, these other stocks like that, Boeing, Apple, they haven't really shown that pattern yet. But much to what Steve just said, if you're doing it on a daily basis, you have to be really close to the vest, in my opinion. If you're taking a little bit longer outlook, that's where I think the opportunity is.
All right, guys, I just want to get that final point in there. All right, coming up next, it's our Face Off 7. Ben Watson joins us live from Salt Lake City, Utah, to talk about John Deere, or Deere and Company. I guess I got to change the name. So stay right here on the TD Ameritrade Network. Fast Market. We'll be right back.